Hey, Gary's Gulch, welcome back. So the Fed finally lowered interest rates. So is it time? Is it time to go get that refinance mortgage or maybe to buy that house? Well, if so, do we do it with a 15-year mortgage, a 30-year mortgage? Do we take maybe use this opportunity to get rid of our 30-year mortgage, that evil 30-year mortgage, and we replace it with something that a lot of people will call velocity banking? It's this secret interest rate thing that came from Australia. They've been doing it down under for years. It's a really cool trick. The bankers don't know about it here in America, but we can educate you with our $4,000 program to help you figure out how to replace your mortgage with a home equity line of credit or a HELOC in first position, they call it, velocity banking, and we're going to save you a bunch of money. Okay, hogwash. It's not a horrible idea if you've already done it, but the thing that you always want to remember is that, at least my premise, and what I've understood in going through my 50 plus years here on this planet, is that the most important thing is to remember there's a God and He acts through you to make really good decisions. And the best thing you can possibly do is bet on yourself, bet on the number one asset, not something else. And if you're betting on the number one asset, the most important thing for you is that you have resources in your hands. And those resources might be money in a bank as opposed to money in a mortgage that the banker doesn't give you back. So let's just look at the numbers though, and let's see which one actually is a financial advantage. And then you can decide on whether you want to maintain control and have those resources, that money in your hands or not. How much you really want to bet on yourself, or, hey, listen, W-2 job, company loves you, doing great, don't have to worry about starting your own business or doing your own investments. Maybe you want to pay off the mortgage, but let's look at the math before you go and do that. Okay? So this might get a little deep, and you may have to stop this one or replay it a few times, or maybe go watch it on YouTube where I'm going to show you my screen so that you can see everything that's going on. All right, let's get started. My fun little squirrel guy here is ready to dig in. He's eating a berry. It kind of looks like he's got blood all over him, but those of you who aren't watching, don't worry. The squirrel is not chewing up some other animal. He's just eating a berry. All right, so let's bring up the actual screen. Here we go, folks. Okay, so this is my 15-year versus 30-year mortgage, and I'm going to just show 30-year on the left, 15-year on the right, and I'm going to run through a little macro here, which is going to ask us some questions and help set this up to make it a little simpler to understand. All right, so the first question it asks is, how big is the loan? Okay, so let's assume that we're buying a $500,000 house, and we're going to put $100,000 in as a down payment, 20%. That's typical for an investment. You can probably get less than that if you're doing a conventional loan for primary residence, but let's just kind of make it simple, and we'll say we're borrowing $400,000. So you may not be able to see this smaller little input thing, but I put in $400,000. And then the next question was, what is the annual loan rate? Okay, so it's about 6% today. Maybe you can get it down to 5.5%. Maybe the Fed lowers the rates a couple more times like they hinted they were going to do, and maybe it gets down into the 5s. And that's fine. I'll just go rerun this for you if you just reach out to me at gary@garypinkerton.com, and we'll put that in. But for now, we're going to go with a 6% loan rate. Okay, and it says, how long is the longest mortgage? Well, we want to do 30 years, so that's 360 months. So we'll put that in. And then how long is the second mortgage? So we're going to do 15-year mortgage for this one. And so that would be 180 months. Okay, so here we have both of the loans. Okay, so 15-year on the right-hand side, 30-year on the left-hand side. Both of them are at a fixed interest rate of 6%. Okay, so maybe you say, hold on, what about the fact that I can get my 15-year mortgage at a lower rate? I can get like 5.5 or 5.75 compared to the 30-year mortgage. Okay, we'll circle back to that at the end. I want to keep this nice and simple for the moment. So we're going to look at 6% for everything. All right, and so what it shows us is that there is the payment for the 30-year mortgage is $2,398.20, and the payment for the 15-year mortgage is bigger. It's $3,375.43. Why is that? Well, the answer simply is that you have to pay off the principal faster over 15 years, not 30 years. And so as a result, your payment has to be bigger to get this thing done in a faster period of time. Okay, that sounds pretty simple. And often you will hear that the cost of a 30-year mortgage is so much more. You're going to pay a lot more interest. And yeah, it's true that along with the $400,000 principal that we're paying off in both these scenarios, the total cost, cumulative cost, that is, of the payments that you made over 30 years is $863,353. The cumulative cost for the 15-year, it's less. It's only $607,577. So how much interest did we pay? Well, on the 15-year mortgage, right, we paid $407,000 or $207,577. So we paid the $400,000 principal back and $207,000 and change in interest. That's pretty simple. And the other one, we paid over $400,000 in interest. If you take the $400,000 principal out, it's $463,000 that we paid in interest, right? So it was more than the principal. And it was definitely more than we paid over 15 years. And so most people will stop there and say, that's more expensive to do a 30-year mortgage. You should pay it off earlier, make extra payments, or do a 15-year mortgage. And yes, all of those will result in paying less money in interest. But does it cost you in your life, your net worth, your financial wealth, does it cost you more to pay more interest on the 30-year mortgage? My answer is absolutely not. And there's many reasons for that, but let's just go through the math here as we go on. So let's go to the next question. Okay, so the next thing I want to bring up is that if it was true, if it was really true that paying less interest meant that you were better off, then the absolute best thing to do is just to pay cash, right? Like even the 15-year mortgage had $207,000 in interest on it. Yes, it was less than the $463 on the 30-year mortgage, but it's because we had it out for a less amount of time, right? Well, let's just never take out the loan. Let's just pay $400,000 for the house. That's $0 in interest. That's better. And let's assume for a moment you had the $400,000 that you could have paid. And you decide maybe I'm going to go do that. Okay? Well, let's think about it. Every time you make a decision, you're choosing not to make a different course, right? When you get to a fork in the road, you choose to go right. Well, that means you also chose not to go left. And what would have happened had we gone left? Well, we don't know. That's kind of the dog that doesn't bark, my friend Jason says. Like, you won't be able to see down that path. But with math, we can. All right? So let's look at both paths. If we choose to pay cash, then we don't have that cash to grow anymore. But had we chosen to do the 30-year mortgage, we would have had $400,000 sitting in a savings account. And so for the moment, we're going to assume that all the rates are the same and that we could earn 6% in a savings account without any taxes. How in the world are you going to do that? Well, a life insurance policy, infinite banking, or family banking that I talk to you about all the time on this podcast gets pretty doggone close to that today. So let's just say we can do 6% in an account. All right? And so if we look at not putting that money into the house and instead taking that $400,000 and growing it 6% for those 30 years, it would turn into $2,409,030. $2.4 million is what I gave up when I chose to take that money and put it into the house. Now, is that true? No, that's not really what we should have said. What we should have said was we worked every month for those 30 years, and we came up with $2,398.20 to make that monthly payment on the 30-year mortgage. And after doing that, we realized we have a paid-off house, and we have that $400,000 we didn't put into the house, and we made 6% on it, so we have $2.4 million, right? So we have the $2,409,030, and we have a paid-off house because we made the payments. Okay, but the other thing we could have done, the other fork in the road, is that we could have just paid cash. And if we had paid cash, I think you'd agree that we have this $2,398.20 that we don't need to pay on a mortgage anymore. So what do we do with that? Well, we simply put it into that savings account that we have, the 30 years of savings at 6%, right? So we have the savings bucket that we emptied because we wanted the $400 in the house, but now we can just put the payment in there. Well, guess what happens if you put the $2,398.20, 360 payments of that into your account? Well, you end up with a paid-off house, and monthly payments over 360 months turns into the same $2,409,030. Now that might blow your mind, and you might say that's crazy, but go get a calculator, right? Just go get a simple interest rate calculator and say, hey, my savings account. In fact, some banks have savings account calculators. If I put this much in my savings account, what's it going to be worth, right? And if you do it without taxes, you'll find out that this payment over 360 months, growing at 6%, will give you the same $2,409,030. So what I'm saying is, you can put the $2,398.20 once a month into the property that you're making this money by working, and you pay off the house in 30 years, and then you had the $400K you didn't put in there, and you grew that at 6% in that savings account, and you ended up with a paid off house and $2.4 million. Same thing happens if you just take the cash, put it in the house, and then use the payments to build up the savings account. You got the same paid off house and $2.4 million. Okay? But there might be some other things that are different. But let's go to this 15-year mortgage for a moment. Okay, so this one's a little bit different. So over 15 years, we make a bigger payment, and we end up having, the 3,000. So if we, excuse me, let me back up. So if we had paid off the house instead of the 15-year mortgage, well, and then we took those payments and we just put those into the same savings account for only the 180 or the 15 years, then we end up with $981,637. We don't have the $2.4 million. Well, why is that? Well, it's because time. And this is the biggest thing that there's two really huge things that I want you to take away from this conversation today, this little education here. One of them is that if you take the value of time out of the equation, you get the wrong results. So let me say that again. If you take time out of the equation, you're not doing financial math, and you're going to get a different result. And that's how people can trick you. So let's do a quick little thought example. Let's say that you come to me and you say, listen, I have $1 million and it's not really growing right now. It's sitting in my checking account. And what I really want is to be able to take time with my kids. We're going to go on some vacations around the world. I want to coach their soccer team. I want to cut back on my business or work. And I need to be able to do that. I need $100,000 a year. And I say, okay, I'll tell you what, I'll borrow the money from you. We'll set up a contract and I'll give you $100,000 a year back. And I said, would 10 years be okay? And you're like, yeah, I think that's okay. So what I want to ask you is, would you do that deal? Would you give me $1 million today, and I'll give you back $100,000 a year for 10 years? Okay, if you say yes, well, then you don't understand the time value of money. Did I give you back the full $1 million? Yeah. So what I'm saying is, I borrowed from you. Let's go over here. All right, so I borrowed from you $1 million, and then gave you back $100,000 over the next 10 years. Okay, so essentially, I really had it. I give you $100,000 at the end of the first year. That's a year from now, right? So really, it's 11-year period of time. But 10 years, paying at the end of the year. If I pay back $100K a year, that's $1 million I paid you back, and you got a 0% rate of return, right? But then you wise up and you're like, no. I'm not going to let you have $1 million for 10 years or some of it for 10 years and pay me no interest. Like, I want a little bit of an interest. And I go, okay, how about this? Or I want a little bit of a return. I say, okay, how about this? I'll give you back an extra year's worth of payment. All right, so I'll give you 11 payments back. I'll give you $1.1 million. I'll just kick it in the very next year, make you 11 payments annually. And you go, okay, well, that's a 10% return. Hey, now we're talking. I've seen investment sponsors tell me that a given return, a total return is a good return. $100,000 on $1 million, that sounds like a good deal. But you always have to say, well, hold on a minute. How long does it take me to get this money back? Because if I just make 11 years worth of payments here, that's a 1.62% return, not a 10% return. Yeah, the total return on your investment was 10%. It was $100K on $1 million, but it took you 11 years to pull that off, right? So, let me show it to you in a little bit different way. Maybe this will help as well. So this just shows the stream of payments. This is called an internal rate of return calculator. And the internal rate of return calculator is the great equalizer. This calculator is the one that will help you understand what the true return is. Okay, so here in this example, I just paid back the $100,000, gave him $1 million, got $1 million back over time, and it's a 0% return. But if I carry it one more year, now I've gotten 11 payments back, It seemed like it was a 10% return, but we just figured out it's not. It's a 1.62% return. Well, what if we do another one? That's 200K back, right? Over on $1 million. Took me 12 years, sure. But is that better? Well, if we go another year and we put another 100,000 in, or get another 100,000 back on our investment, now it's a 3% return almost. And so it's 200K back, that's 20% total return, but it took a long time, and that doesn't help. Okay, so what if we go back to the original 1.1 that we get back, and we change the parameters a little bit? What if I say, hey, you know what I really want you to do is I'll lend you the million, or I'll borrow the million from you. How about this? I'm still borrowing, right? So I'll borrow the million from you. And listen, I get it. You want the money back a little bit faster than that. And that's fine. So I only need the large amount for a little bit of time. So what I'm going to do then is I'm going to give you back 900,000 of the million in 1 year. Right? That sounds like a pretty good deal. So I'll give you back 900,000, and then I'll just kind of go silent for a while, and then the last 2 years, I'll bump in that last part that we talked about. So this might get a little confusing if you just listen to the podcast. But basically what I did is after 1 year, I gave back 900K. And then the last 2 years, I bumped in that 100 a year that I did before. Okay, that actually improves the return from the 1.62. Now we're up to 3.9%. Why? You got the money back faster. Clearly, if I borrow $1 million and a year later give you 1.1 million back, right? I give you 100K on top. Yeah, that's a 10% return. Let's just check that real quick and make sure that what I just said there is accurate, right? So we're going to just wait a year, and I pay back the 1.1 million, and yep, that's a 10% return. When you get the money matters a lot. Okay, I think I've driven that point home. We're gonna move on from that one. All right, so let's get these two guys out of the way. We're back to our calculation here. Okay, so I paid the 33.75 for the 15-year mortgage over 15 years, 180 months. It's paid off, and I put in 981,000, but I don't have the 2.4 million. What is going on? That's the time factor, right? We're only looking at 15 years in this example. We got to look at the full 30. Well, what am I going to do with that? Well, let's just take the 981,000 that we have saved up in this savings account, right? Because remember, this 15-year scenario is I paid cash for the house. I took what I was going to put into the property, monthly payment, put it in that bank account. But I'm done now. I've done my 180 months. Well, just let it sit there and grow. Take that 981, 637, and keep it growing in that account, right? Because we want to get out to the full 30 years. And if we do that, it also turns into the 2.409030. Every one of these scenarios is the same. It is true that you pay less interest when you do a 15-year mortgage, total interest accumulated, you pay less than you do if you're doing a 30-year mortgage. But you certainly pay a lot less if you're just paying cash, right? So if the goal is to pay less interest for some reason, then yeah, pay cash or 15-year mortgage. But that doesn't mean the cost of your property is less. So we're going to dump all these up here into the top, and what we see is that it is 2.409030, whether you pay cash and save the payments in a savings account at the same 6%. You can save the 15-year payments and grow them for another 15. You can save the 30-year payments once a month. Doesn't matter. They're all 2.409030. But are there other factors that we should take into account that might impact this a little bit? Yeah, there are. Let's take a look. What if you're living in the real world and you have an income tax bracket? You have taxes. Are those taxes deductible? Yes, in both cases. Primary residence, rental property, you can deduct the interest made on payments for your primary residence up to $750,000 mortgage. And if it's a rental property, there's no limit on it. But whatever you pay as interest cost for an investment, you can deduct against income from that investment. So yes, it's deductible, but let's stay with primary mortgage here. So we can deduct it. So what tax bracket are we in? All right, I feel important here that we take a little bit of an aside. So give me just a second, and we're going to take a quick break, and I'm going to talk real quick about taxes because I hear this all the time as well. There's a lot of misconception out there about tax brackets. So let's take a quick little deep dive here. All right, so here is a tax illustrator tool, a calculator, I guess, that I use to help my clients out. And the reason I'm talking about this is because tax brackets are confusing for people. Tax brackets, sadly, are confusing for some tax preparers. Hopefully not CPAs, but a lot of tax preparers. And you'll hear people talking about going into new tax brackets, and frankly, that's scary for people. Just like paying a lot of interest is scary for people, because on the surface, we think it's a bad thing. All right, so let's say that you are a married couple in 2025 and you make $206,700. Why did I choose that number? That happens to be the top of the 22% tax bracket. I just wanted to not have any dollars sitting out there, make it confusing. Okay, first thing, let's talk about these brackets, all right? So in America today, 2025, with the big beautiful bill tax law that came out, it reinstated or continued on some stuff that came out in 2018 where we had much lower tax brackets. All right, so the bottom tax bracket's 10%, the next one is 12%, and then the next one's 22%, and then we go up to 24%, 32%, 35%, and it keeps going. Okay, so we happen to be earning at the very top of this 22% bracket. So you're in 3 brackets in this family, and if you can watch this on the video, you see that there's 3 different colors here, and we have the different brackets, okay? And so this person is going to pay $35,302 as a married couple with no state income taxes, all right? Just keeping it simple here for the moment. All right, so how did they pay that $35,000? Well, the picture on the right-hand side over here will show you what's happening, right? So for the first $23,850, we were in a 10% bracket, so that math's pretty easy, $2,385. And then the next bracket, we pay 12% on this $73K, and that's $87.72. And then the next bracket, we end up paying $24,145. All right, so in total, it's $35,000. Well, what happens if you get a bonus, a $10,000 bonus, all right? Well, you go to your not-so-intelligent tax preparer, and he says, ooh, that just kicked you into a new tax bracket. You're now in the 24% tax bracket. Okay, now here, again, is what some people, and sadly some tax preparers, will do, and it's not good, right? So I find my little calculator here. Here we go. All right, so got a calculator, and we're going to say, all right, well, now I'm going to be making $216,700, and he said I just went into a 24% tax bracket, so that must be times 0.24. 24% is $52,000, and you're like, wait a minute, I was only paying 35. It looks like I hit enter here, so let me get rid of this for a second. All right, so I was only paying $35,000, and now I'm at 52. Oh my gosh, that's more than $10,000 more. I don't even want the bonus. Boss, take the bonus, man. I don't want it. That's going to put me in a new tax bracket. I'm in trouble. Okay, so most people, most of you all, probably know that's not what happens, right? What happens is the new money gets taxed at this higher bracket. It doesn't recharacterize everything that you're making and put it into this big new bracket. Right, so simply we have 24% that we had to pay on $10,000. That's another $2,400, right? And so as a result, we went from 35 up to 37.7. Okay, so I just want to make sure that everybody understands that this is not what happens. We don't recharacterize everything to a new tax bracket. It's just the new money that we made. If you earn $10 in the new tax bracket, it's just $2.40, that you have to pay, and it's just a little bit more than it would have been if you were still in the 22% brackets, 20 cents more, right? So not a big deal. Don't freak out with changing tax brackets. Okay, so we got that out of the way. So now let's go back to our world here. We're back to the $206,000 that we make. But in America, you also get a standard deduction. Each person gets $15,000. This is one of the things that's not screwed up with the married penalty, where you get less than if you're single. So married couple gets $15,000 each, or $30,000. So here is the next big important thing. Remember, the first important thing was that time matters, and if you take time out of the math, you're not doing actual financial math, and you're going to make big mistakes. And one of them is probably replacing your 30-year mortgage with a 15-year mortgage, or paying cash, or getting one of those velocity banking things. But let's just hold that to the end on how it plays out. The second big thing that I want you to always remember is that every decision you make is a last dollar decision. Let's say that again, and I recommend you put it on like the screensaver on your phone for a while, or maybe on the mirror, or on the dash of your car. I need you to think about this every time you're making a financial decision. Every decision, every financial decision you make is a last dollar decision. It means that everything else you did that tax year is weighing in on and setting up the answer to, is it okay to go do what I'm about to go do, right? So for example, when we get this $30,000 deduction, it comes off of the 206,700 and the taxes associated with that, but it's a last dollar decision. It saves us money at the very top tax bracket. That's a good thing, right? It's not like it just chopped off this low tax stuff we had down here at 10%. It comes off at the top. So every decision we make is a last dollar decision, okay? So that's why the tax bracket matters. So we have this mortgage, and the 30-year mortgage has more volume of interest that is paid. And even in year one, it has more volume of interest. Well, how much interest is paid? Well, let's look at it. So this is a quick little example of year one of the mortgage. And the reason I'm doing this is because it wasn't obvious where the interest was. Where could we find the interest on the other one? So I just did a $400,000, same parameters, and I just said, let's look at the first 12 months up here, just the first 12 months. So in the first 12 months, there's $23,866 in interest on that loan. Is that more interest in year one than it would be on a 30-year mortgage? Yes, it absolutely is. Why is that? Well, because in the 30-year mortgage, you're paying the principal down. So the balance is less, right? So let's look at the balance here of the 30-year. And if I shift this over to be a balance of if I'm making larger payments, right? So I'm making this bigger payment on the 180 or the 15-year mortgage, but the principal's going down faster. So yeah, it's less interest, right? So it's only 23,538, but the number I really came in here to get was the 30-year mortgage. Okay, so on the 30-year mortgage, it's 23,866. That's how much interest I'm paying. So back on my tax thing over here, if I come up here and I say, hey, I'm getting an extra federal tax deduction up here on the top right of 23,866, that comes off as a last dollar decision. So it's saving me taxes at my highest tax rate, right? Not these lower rates. I didn't get screwed and have to take it off of the bottom. Again, it saves me at the highest last dollar decision. And that brought down my taxes by $5,000, right? So the more interest you have, the bigger interest deduction you get on your mortgage because your balance is still high, the bigger deduction you get in America. All right, we're getting out of the taxes. Good news, taxes are behind us, all right? So, but the next decision here is it says, what's your tax bracket? Okay, so we're in the 22% tax bracket, right? Now look what that did. It said, hey, on the 30-year mortgage, because of the savings that I got from taxes, which are bigger than the savings I would get on a 15-year mortgage, even in year one, but definitely because we're doing it for 30 years, not 15 years, the actual cost for my 30-year mortgage feels like $2.068 million, not $2.4 million. And yeah, the 15-year mortgage goes down a little bit too. It's down to 2.2. And again, the reason that the compound cost is less is because I get tax savings along the way. It doesn't cost me the full 2.409 compound cost of all those payments that I made. It doesn't cost that much. It's $341,000 less. Okay? Well, what's it have in store for us next? All right, so it puts the money up there so we can see it. Now the next decision is, what's the inflation rate? Okay, what does inflation have to do with anything? Well, what inflation has to do is that everything is impacted by inflation. You've heard me talk about how inflation is this river that we're floating in, and sometimes we go down and it's narrow and it's flowing fast, and then sometimes it's wide and it feels like it's not moving at all, right? So inflation comes and goes, but it affects everything around us except a couple of things. Anything that has a fixed payment, right? And so your mortgage has a fixed payment amount. So for 360 months, it's going to be the exact same $2398.20. What does that feel like 30 years later? Well, let's say that we're in a 3% inflation rate, right? So 3% inflation over the entire time you own this house results in that payment feeling like it's only $976. Okay, so would you be happy that you have only a $976 payment that started off at $2,400, right? Again, the payment's still $2,400, but it feels like $976. That's only like twice what your electric bill is probably, right? So that's another advantage, is that if you stretch out these payments, you get to lock in something that is not impacted by inflation. Same thing happens with your family banking policy premiums, by the way, right? Whole life insurance locks in the premium. And while it might be a challenge today, it's going to feel like, you're just making the electric payment when you're saving into something that was challenging here at the beginning. Okay, so the takeaways were, regardless of how we do this, if you do a 30-year mortgage, or you do a 15-year mortgage, or you just pay cash for the house, the cost is the same either way. But then when you bring in the fact that you get deductions, it dramatically brings down the cost of the 30-year mortgage and the 15-year mortgage. And then if you think about inflation and the fact that you're being protected from that payment going up, the feeling of the payment is smaller and smaller and smaller. You hear me talk about this all the time when we're talking about rental properties. Your expenses are going up, but the rents are also going up. But if you can lock in that long-term fixed rate loan, your payment does not go up. And so your cash flow goes up and up and up, your net cash flow, because your payment isn't, you have something that's fixed and it's anchored and it's not going up like everything else is going up. Okay, I promised you that we would go back and look at some interest rate things, because people will say, hey, my 15-year mortgage has a lower rate. I can get this rate at 5 3/4, all right? All right, so before I hit enter here, remember that the cost of this mortgage is $2.2 million and it's only $2,068 over here, right? So when I hit enter here and I say, well, I can get a 15-year mortgage at a lower rate, yeah, it went down to 2.176. It's nowhere near this one. You would have to go below 5%. See, it's still not as good as this one over here because of the tax advantages that you achieve by going with the longer mortgage. And what if you can save, what if you can take this money and you can lend it out safely or with some certainty that you will get it back at an 8% loan rate, or you can earn it in your bank or in your business or something at that rate. So if your savings rate, if your opportunity cost goes up to 8% now, then it just gets bigger and bigger, right? So I changed these two to 8. Yes, the numbers are bigger than they were before, but look at the difference now. There's $300,000 difference between these two, because the opportunity cost, you have control of the money if you minimize what goes into this dead equity house that you have, and instead you keep it in your hands and you can go turn around and you can go put it back to work. Okay, so hopefully that helped, and let's just summarize big picture here. We said that if you can keep the money in your control, all other things rates-wise being equal, you will be substantially better off, and the costs of paying cash, a 15-year mortgage, a 30-year mortgage, they're all the same anyway. But the fact that you get tax deductions, the fact that you get your hands on that money to protect your business or to invest, and perhaps at a much higher rate than 6%, take an opportunity when it comes your way. How many times have we seen recessions in a 30-year period of time where somebody has to get rid of an asset that if you had cash laying around, you could get it at a much lower rate? Bottom line, bet on yourself, which will always put you in a better position, because that's you and your connection with the divine, and you being able to get a direct phone link to what do I need to do, and I can turn around and go make it happen. You don't have to go convince somebody else who happens to have your money in a syndication or has your money in the markets. You don't have to go convince them that you're right. You've got your hands on the money. You can put it to work in your business, or you can just go put it to work in your own investments. Thanks so much, everybody. And remember, what you hear in a short little marketing snippet does not tell you the truth. You need to go through the math, and I'll help you get there. Thanks so much. And until next time, 2 big lessons, right? You have to bring time into the conversation, and every decision you make from the respective taxes is a last dollar decision. Thanks so much, everybody. Go make something amazing happen in Gary's Gulch.